let's talk first of all about ESG and kind of the factor approach to ESG. How do these two things fit together?
Yeah, sure, because you're sort of asking yourself, how does this happen? So let's just start with what ESG does, right? And really what it does is it takes alongside like traditional financial analysis, social factors, right? To identify companies that are doing well or there's gender diversity on the board. So if we actually take Bloomberg's Factor to Watch and sort of screen that over an ESG fund, what does that look like, right? If ESG does well over the long term, why? So what you end up getting in an ESG fund is higher quality names, low volatility names, companies with better balance sheets, right? So ESG is sort of producing this low volatility and high quality factor exposure that you see in similar funds.
So there are so many mandates now to invest in ESG, and I'm curious, can it be a factor in itself, Tom?
So yeah, that's a good question. So what I think with ESG is maybe not necessarily it's a factor in itself, but I think it's a really interesting proxy. So for example, things like value, right? Everyone looks at traditional financial statement things like price to book. But if there's now sort of controversy around is price to book effective anymore? Is that really working? I think ESG gives you a different way to look at things and being able to identify metrics with companies that maybe aren't picked up in traditional like financial analysis.